All right, I think we are live. Hey, everyone, and welcome to the Dividend Power Hour. If you are out there, I see you, Chris. Let me know first and foremost that you can hear me, and we will get rolling with this hour special today. You know, it's always great to join all of you and connect back here in the home office after vacationing out in Arizona. It was 115 out there. It is now 90 degrees here in Southern California, so still a little warm, but getting a little bit more of a break. So let me know in the comment section, can you hear me? And we will get rolling with today's edition of the Dividend Power Hour. And in the comment section, as we continue to go through it, just make sure you throw in any questions that you have. This is meant to be interactive, and we'll just continue to go through, answer as many as I can. I know there was a ton of them that we tried to get through last week, and so it's always enjoyable to connect with you guys. So let's get rolling. Let's begin by letting me know which stocks did you guys buy this week. We've seen, a continued climb here in the S&P 500. To start, I see everyone now, all the comments are starting to roll through saying everyone can hear me, so that is good to go. We will get rolling now. So what stocks, first and foremost, did you guys buy this week with the market through the first, we'll say 4 days so far? Let me know down in the comments section. And with that being said, I'm going to set up the slides and we are going to get rolling here. Awesome. Let me pull that down and let's get rolling. So as we always like to look at each and every week, this is our economic outlook. We just look at six main factors here, beginning with inflation, some of the top news articles that we went over, and data points for the economy that hit this past week. So inflation is starting to slow. We saw month over month increase in the headline CPI number of 0.2% month over month. So that's from to June, so month over month. And then year over year for the month of June was 3.0%. Both of those were under consensus, which was a good thing there. We'll talk a little bit more about inflation as we continue to go through the Dividend Power Hour. Valuation, we did see an uptick in estimates. So we've been estimating EPS around 220 for the entire year. That's the S&P 500 earnings. Those are closer now to $230, looking at the latest FactSet report. So that brings, as of the close today, the S&P 500 still trades at a forward price to earnings multiple of 19.6 times. So last week we were at $220 EPS, so it was a little bit higher, even though we've climbed so far for 4 straight days this week. So we were at 19.9 in the prior week, and the average for the S&P is usually around 16 to 17 times. Unemployment, jobless claims fell to 237,000. So the jobless claims that increased 12,000 pretty much last week, we saw those decrease this week. So we're at 237,000 on the jobless claims. The drop, though, could be a delay from the 4th of July holidays for some of those folks that did or may have unfortunately got laid off during or right before the holiday. Odds are they probably didn't rush to fill out the unemployment forms and all that stuff. So there usually is a little bit of delay. So it'll be interesting to see what next week's jobless claims are. And of course, we will cover those here in this Dividend Power Hour. June jobs. The state of the market was all focused on jobs last week. We got the ADP report, which showed that we added 497,000 jobs, which is just way blew out estimates there. And then we had the non-farm payrolls, which is what more of the economists and investors like to look at. Which we saw an increase of 209,000 jobs, which was below estimates, what analysts and economists were looking for. So we did see slower growth. And again, we will talk more about that here in a second. We also like to look at housing at the start of the Dividend Power Hour and look at what the average 30-year mortgage is. And it's still hovering right around 7%, which is just astonishing. It'd be interesting if we could take a poll right here, just in the comment section, just see, how many of you have interest rates, for those of you that own homes, interest rates below 4% right now. It'd be interesting to see what percentage of folks out there have a 30-year mortgage or whatever your mortgage is in terms of years below 4% right now. It's astonishing. And that's part of the reason that we see these low inventory numbers. As I mentioned here, housing costs remain high. The housing, especially around here in my neighborhood, we haven't really seen a dip in housing prices, and inventory remains low, even though the interest rates are at 7%. And that's up from, if we go back a year, 12 months ago, 30-year mortgage was at 5.5%. And then the last thing we're going to talk about here at the top of the Dividend Power Hour is bank earnings. So Q2 earnings season kicks off officially tomorrow, Friday, July 14th, and we'll be starting with some of the big banks. We also have United Health Group that'll also be reporting tomorrow. So it'll be definitely interesting to see what's going on. So let's head over to the comments section real quick, and let's take a look and see what you guys bought this week. So let's see, Chris bought some AbbVie, Johnson & Johnson, and some ARRY recently. Speaking of United Health, Dresh bought United Health this week. RL bought JEPQ, Mo, and Fast. So RL is looking for some nice yield right there with those, with most of those stocks right there. Matt, how's it going? Let's see what Kevin got. He got himself some Microsoft, VYM, XLE. So, I actually picked up some XLE this week too, just a little nibble. And then PepsiCo, who reported earnings this week as well. David, hi from Israel. Awesome. Thanks for tuning in to the Dividend Power Hour. Lex is at a 3%. Awesome. That's a great mortgage rate to have there. Drash is less than 3%. Oh, we are taking the poll right now. I love it. 3.2. Matthew's at 275, which is what I'm at there. 375 for Ryan, 3% for James. Mike is on a 15-year at 2.5%. So you could see that, a lot of these folks here, and this is what goes on, throughout the entire country right now, is there's a lot of folks that refinance during those low interest rate environment that we saw. So it really doesn't make a lot of sense right now to move. Why would you want to move away from your home unless there's some, financial situation, a job relocation where you're really forced to do it? But if you're not, why would you want to move from a 3 or sub 3% mortgage rate and go grab a 7%? You're going to be able to, maybe you can move from, say you're going from California over to Idaho or Tennessee, where you can save some money on housing, but then the interest rate makes up the difference. So it's a tough spot to be in right now for homeowners or first-time home buyers, I should say, that are just really looking to get into the housing market for the first time. So let's head back here to our slides. And we mentioned that bank earnings are kicking off this Q2 earnings season tomorrow. So we have the likes, and tomorrow being Friday, July 14th, if you're watching this in the future. So tomorrow we have JP Morgan, JPM, we have Wells Fargo, WFC, and we have Citigroup. We also have BlackRock, but those are the three large banks that'll be reporting. Bank of America is going to be next week. I believe it's on Tuesday, which is the single bank that I own. So what are investors watching when these banks are going to be reporting tomorrow? Well, for myself, I'm going to be looking at deposits because, we had that mini regional bank crisis at the start or right around March. So it was the third month in, but and how banks have recovered from that point. So where are deposits? Are folks taking their money out? Are they moving them elsewhere to different banks? Or are we seeing folks take their money out of regionals and maybe move them to the big banks of JP Morgan, Wells Fargo, Bank of America? We also want to get an update on the commercial real estate comments. So those are going to be coming through in the conference calls. I'll be watching those pretty closely there just to see the state. Are we going to be writing down a lot of these commercial real estate deals? It's really, Wells Fargo has a big commercial real estate business, so it'll be interesting to get comments from them. I have some option plays going into tomorrow with Wells Fargo, so we'll see how that goes. We're also going to be looking, or I'm going to also be looking at reserve activity. How are the banks looking at things as we move forward? Are the banks looking for delinquency rates? Are those going to start to climb? Because as we've seen, credit card numbers continue to rise. More and more folks are increasing in their credit card debt. We haven't gone to delinquencies yet. We're just seeing the credit card numbers rise. So it'll be interesting to see what are the banks banking on. Are they, no pun intended there, are they increasing their reserves? Is it more for commercial real estate, or is it more for consumers in that increasing debt that we're starting to see? Because remember, in the fall here, we're going to start seeing repayments of student loans again. So, a lot of that consumer discretionary that we've talked about the past few weeks isn't going to be able to be spread out as much. So that'll be interesting to see how the banks are doing from that standpoint. So we mentioned jobs. That was the key focus last week. We got mixed reports. We saw this blowout ADP report, which focuses mostly on private payrolls. So these are just private companies. They're clients of ADP. And when you dive into that report, even though it was almost 500,000 jobs added, it was a majority of them came from businesses that had 50 employees or less. So it wasn't a huge representation of a large majority of the workforce. Now, the Labor Department, the one that came out on Friday, that really handles roughly 80% of the entire workforce here in the U.S. And that one showed that we had 209,000 jobs added during that month, but that was the slowest growth we have seen since December of 20. And you can see that monthly job creation over on the right side of the screen there, how it's just slowly been peaking out and or slowly climbing lower, this being the lowest since that December COVID month. And it would have been even lower as you dive into that Labor Department one, 60,000 jobs. So 60,000 of the 209 came from government positions, mostly state and local positions there. So that was interesting to look at. So although the growth is slowing, though, we saw unemployment decrease by only 0.1%. So the unemployment rate currently still sits at just 3.6%, which is just incredibly low. It's still just a very stable workforce right now, even though rates continue to rise, and we expect those to continue to rise moving forward. So wages is not, unemployment's one thing we look at, but we also want to look at wages, which is very closely watched by economists and investors alike. And month over month, we saw hourly earnings climb by 0.4%, and we saw hourly earnings climb by 4.4% on a year over year basis. So really just some strength, some broadening out here. On the right side, you can see the year over year percentage change in average hourly earnings here in the US. And it's just been pretty stable. It's slowly starting to go lower and lower, but you can see that the comps from this year to last year, they had 5% plus growth. So it's still solid growth there, but not as fast as folks would like to see. So inflation, though, was another one that we saw in terms of reports since we last spoke. That was CPI that came out this week. So CPI for the month of June climbed 0.2% month over month, which was below expectations. And year over year, we saw 3.0%. So 3% flat year over year growth. That was the lowest level since March of 2021. Investors definitely cheered that as we've seen the market continue to climb this week, and it's climbed for 4 days straight now. Core CPI, which takes out more of the volatility with food and energy prices, that climbed 0.2% month over month and 4.8% year over year. So that's the core CPI versus the headline CPI, I should say, just to correct that, that the Fed looks at, both headline and core. So are these actually slowing? That's kind of my question right now, is when I look at this and see, okay, that's great. 3% year over year, 0.2% month over month. But are we really seeing these the CPI really slow, or is it just the comps were that much higher? Because a year ago we were at that 8 or 9% growth that we saw. So it's definitely something interesting to look at when you're looking at CPI. Some of the big factors on what had the pressure on CPI this month was airlines were down roughly 8% month over month, and I believe they're down right around 19% year to date there. So there's been some pressure that's come off of the airline prices. But when you look at Delta, United, they recently Delta increased their guidance again. So these are usually the best months for them throughout the year. So they increase guidance. So that's always a good thing to see from a company. That brings us to our first question today in the Dividend Power Hours. We're roughly 15 minutes in. Given the latest economic data that we just, that we've seen, including jobs, we got the jobs report. We've seen CPI coming down. Wages are stabilizing. We're looking at unemployment at just 3.6%, which is, pretty close to full employment. We saw jobless claims decrease. What is the Fed going to do next? We're still at core CPI still right around 5%. And that's really what the Fed is focusing on. They want that core CPI number, which is at 4.8% as of June, year over year. They want that number to be closer to that 2 to 3% range. So how many more hikes do you think the Fed will do just moving forward? That could be this year. It could be over the next 12 months. So do you think it's they're done? They're just pausing. They're done hiking. And the next thing we're going to see from the Fed is likely rate cuts. Do you believe there's one more hike left, which we have a July meeting coming up here? Or C, do you believe there is 2 or more? Let me know down in the comments section. What is your thinking right there? So RL believes there's going to be one more hike. Chris believes there's going to be one more. Lex believes there's going to be two or more hikes. Matthew believes there's going to be 2+, so he's in that C category with Lex. Ben is in the category of one more hike. Total Returns believes there's only going to be one more hike. Ryan believes there's going to be 2+. Chris is cheating and going B and C. Jim, 2 for sure this calendar year. Drash just believes there'll be one more. Just one for, I'm going to try this, Negum. The Dividend Investor CPA believes there's going to be 2+. Good to see you, my friend. And we're going to go with 2+ here. So it's really a mixed bag of between, are we going to see 2 hikes, 2 or more hikes, or just the one here? Didn't really get any answers that I've seen, just browsing through all of these, that we're going to get no more hikes. So none of you believe that we are going to pause with the Fed here moving forward. And that leads us right into this next portion of the Dividend Power Hour. So that brings us to the Federal Reserve. So the consensus, we always have this slide up here to kind of see what the CME group, they have a Fed watch tool that they put out for, the next meeting and the subsequent meetings after that, just to kind of see and gauge over a survey of where folks think the rates are going to be moving forward. So the next meeting is going to be on July 26th. So that's coming up in a couple weeks. And consensus has remained unchanged from what we looked at last week. It's still 92% believe that we're going to get a 25 basis point rate hike, which many of you, agree with in the comment section. And there's still 7.5% that believe we're going to pause. So I'm in the camp that we're going to see at least this one here in July. I think that one's already really baked into the market. However, when we look ahead, and let me bring up my screen here, and this is the CME group that you can go to and look at. This is exactly the chart that I kind of show you. You can see the different meetings that we have coming up here. So this is the July 26th meeting, and then you can see here's the September. So this is the meeting that's going to be after the July one. So they go on a little bit of break for the month of August and parts of September before they come back and meet again towards the end of September. So right now, going back to July 23rd, you could see that the current target rate, we're right at that 525, 5.25, I should say. So 95% of them believe that we're going up to the 525, 550 range. So that's going to be a 25 basis point increase. And since I've pulled that chart, it's actually increased even further to 95% now. So if we go out to the September meeting, you can see that, with the July hike is going to put us in this range of 5.25 to 5.5. Now 84% of participants believe that, hey, that we are done. After the July meeting, we are done hiking. That's what 84% say. There's still 4.5% that are saying, nope, we're not even hiking in July, and we're definitely not hiking in September. And then there's 11% that's saying, nope, we're hiking in July and we're hiking in September. So this is the group, this is our C group in our question here that believed we were going to get 2 more hikes. So it's definitely interesting. It seems like the consensus right now is that it's likely that we were going to get at least one. That's where everyone's at. We're just going to get one more hike, and then we're likely going to get a pause. I don't hear much in the camp of, rate cuts. I don't think that's really on the table anymore. I don't think folks are talking about that. I never even believed that because the economy has been, quite strong. And as we've talked about a lot on the Dividend Power Hour, the fact that is when you have dividend cuts, when they start or dividend cuts, when you have the Fed cutting rates, it's likely meaning that there's something fundamentally wrong with the economy. And the underlying pieces right now are showing that the economy, the job force, we're still seeing it's slowing, but it's still there. We still have unemployment rate of 3.6%. Consumers are still spending money. Businesses and companies are still making money. But we're going to see the big Q2 earnings, which we're expected to see a huge drop off. This is going to be the one quarter where we're going to see massive negative growth in terms of EPS. So it's going to be interesting to watch there moving forward. So, still seeing a lot of the comments continue to come in. It's really split between the B and C group. So, it'll be interesting. So let's keep rolling here. And I think I had mentioned. Nope, we haven't got to that yet. So now it gets to the premise of today's topic. So is it a green light to buy? We're seeing that, it's a focus that jobs are still stable. Earnings are plateauing out. So we're not seeing a big drop off. We're not seeing huge jobless claims. Unemployment remains the same. at 3.6%. That's almost full unemployment. So is that a green light to buy? We know we're already banking in that the Fed's going to hike at least one more time. They're going to hike one more time at least. We may see only 11% believe that we're going to get another hike in the September meeting. We can even go out. Let me go out here into, and I'll bring it up so that you guys can see it as well. Let's go out to November. I haven't even looked at this one yet to see what folks are thinking. So 71% still think we're going to be in that category of 5.25, which is going to be the one Fed hike. But now we're up to 23% believe we're going to go up to 5.5. So what that is telling me is that almost a quarter percentage of the people, 25% believe we're going to hike in July, we're going to pause in September, and we're going to hike again in November. So it's going to be a quick turnaround there because we have the September 20th meeting and then the November 1st meeting. So it's only about a month and a week or so between those two meetings. So that's interesting to see. So this is more where that C group believes, that we're going to get that second hike. And then if we go out to round out the year, December 13th, 60% believe we're going to still get that one hike, and almost 20 or 17% believe we're going to get the two hikes. So, and then 20% actually increase to some rate cuts. So I still don't think that's on the table, but that'll be definitely interesting there. So thank you guys for, replying there it's always great to see what your thoughts are. So knowing what we know now, do we believe that this is a green light to buy? Obviously, investors have, especially in the technology sector, but we've seen inflation coming down. We've seen unemployment remain low, and the economy seems to be on stable footing so far. The Fed is likely nearing, however you want to look at it, one, maybe two hikes, but it seems like we're coming to the end of this rate hike cycle. Thank goodness for some folks. But the thing is that valuations still remain elevated. We looked at the S&P 500, which trades at almost 20 times forward-looking earnings. We're going to see a big decline in Q2 earnings here, but then we see a little bit of revenue growth expected in Q3 and Q4. That's still, we'll see if that makes sense. But we need those earnings to catch up because remember, it's a price to earnings metric. So as the S&P 500 price continues to climb, earnings are still staying down here. And they're actually going to drop here in Q2. So we need those to kind of catch up to this earnings that we're seeing. You can't just keep buying a stock if they're not making money. The S&P 500 can't keep going up if companies, especially the largest companies within it, the Apples of the world, Microsoft, Google, and all that, aren't making money to keep up with that growth. That's when you'll see a sell-off. So that's what a lot of investors are a little timid on right now, is these high valuations. The earnings now have to catch up and prove to it. So again, we're not going to see earnings growth in Q2. Q2 S&P 500 earnings decline is expected to be 7.2% according to FactSet, which would be, this is an interesting note, the largest year-over-year decline since Q2 of 2020. So if we get negative growth as expected, that's 7.2% negative growth here, do you believe that GDP will likely fall in Q2? Does that mean it will fall again in Q3? It's usually a little bit behind. Could that be setting us up for a potential recession? And that's where, a lot of the economy, that's why I say it looks great right now. But remember, at the same time, we have credit card debt continuing to rise. We have student loans that are going to have to be repaid yet again. That whole student loan repayment stuff is off the table right now. Those are coming due here in the fall. I believe it's in October. Credit card debt's going up, as we just mentioned. We're not at delinquencies yet, but it's stuff to think about as an investor. Is there some stuff on the horizon to be aware of and to make us a little bit more hesitant just to go, balls to the walls and just buy everything we see here? So definitely interesting. I want to know in the comment section, will be another question. For the second half of the year, are you going to be a net buyer or a net seller of stocks? Let me know in the comment section below. Are you planning to buy more stocks in the rest of the year, the second half, I should say, of 2023? Or do you think you're going to be selling more stocks in the second half of 2023 when you put them together? Let me know in the comment section below. Don't you dare say dividend. Oh, we don't want to see any dividend cuts around here. That's for sure. At least in the stocks we invest in. Lex is asking, yes, that 5. He was already ahead. Lex knew where I was going with this. Good question, Lex. Do you think there'll be a recession? If so, when? I've always been in the camp of this Q4, but I've also been proved wrong that the economy it's been staying a lot more steady for a lot longer than I had expected. And it's really, we talked about it last week when I was on vacation. We talked about this soft landing, and it's becoming more and more. It looks likely. I'm not saying it is likely to where I'm moving like, oh no, the Fed's really gonna have this soft landing. It's just starting to look more likely, and I think that's where a lot of this higher level that we continue to reach with the S&P 500 is there are a lot of folks that have stood on the sidelines, and that FOMO stuff is starting to kick in a little bit, and that's when you can kind of see a large move. And I think that's what some investors are looking at. It's like, hey, I've been sitting on the sideline. I've missed this big rally. And that's why I always say it's important that I prefer time in the market over trying to time the market. Now, you want to do, there's a little middle ground that you want to do with that. But, you never want to just have, 50, 60, 80% cash and on the sidelines waiting for some big extravagant recession or pullback in the market. If you look at my dividend, and I know you're a subscriber to the Dividend Investors Edge, that I have a top 10 position in cash. I'm looking for opportunities, but that position has slowly been coming down over time because I continue to look. There's still opportunities in there because we've seen a lot top heavy moves in a lot of stocks, the Apples of the world, the Nvidias, the Meta platforms, Google's, the Microsofts, and we're going to look at that in a second here too. So if I were to get my magic 8-ball out again, I'm guessing, if I were to think a recession would probably come around Q1 of 2024. So I think it's going to be close because I've always been also in the camp that thinks it's going to be a very shallow recession. I don't think it's going to be anything like we've seen in the recent recessions, nothing like 2020 or the years before that. I think it'll be more in the shallow recession if we do, in fact, fall into one. So good question there. And it seems like Point of Tranquility believes there's going to be a mild recession in 2024 as well through 2025. Chris thinks it's safe to buy. He's given the green light there, folks. The Dividend Investor, CPA, another fellow CPA out there. People should be basing their buy decisions based on company quality and valuation. The rest is noise. And this is definitely some great advice there. And that's what I've been talking about is that there's even though the stock market has been climbing and valuations are, we talk about it a lot here on the Dividend Power, valuations are really high. But when you look at the market as a whole, when you look at a lot of these technology companies, but there's still a lot of stocks where valuations are quite low. And that's how I'm always able to do, YouTube videos on, 3 stocks to buy, 3 REITs to buy, 3 dividend aristocrats, 4 dividend kings to look at, because there's always some great values out there, regardless of what's going on in the overall market. So that's some great advice there from the Dividend Investor CPA. Hello, Johnny. Chris is a buyer for sure, definitely not selling. Dress, should I pause long-term DCA into QQQ? How will the QQQ rebalance affect the index? That's a great question. That's something that a lot of investors, especially on in the media, have been talking about. For QQQ, obviously very tech heavy. I'm not investing in any technology companies per se. I'm doing it by utilizing options. So I've been having some debit spreads with Amazon. I had a Coinbase one that just went off the blocks today. I sold a put for that, and that one climbed. I think we're up like $350 in less than 24 hours on that one. I've had Google options that I played. That one made. I think we were up 750 or so, and those are all posted in my Cash Flow University Discord group. So we've been doing good, but I've been utilizing options, so protecting downside, and also looking for to take part in the upside, but not jumping in with regular capital. So that's the way I've been approaching it. Just because QQQ and a lot of these big tech companies, that the valuations just don't make sense to me right now to enter. I'm a long-term investor. I own Microsoft. I own Amazon. I own Google. I'm not selling them because I'm a long-term investor, but I'm certainly not looking to buy them right now. And if you are looking to buy these, just make sure you do your due diligence, of course. Obviously, I don't give any financial advice, but the good thing is if you look back over the past 12 to 18 months, the valuations or the prices are still lower. So you're not buying them at least at peak levels that they were the past 12 or 18 months. So if you are looking for a positive note on any of this, that's what I'd have to say on that one. So good question there. So RL is going to be a net buyer. Lex is holding cash and staying put. He's looking for that good opportunity. Lex, I know, already has a he's talked about it on here, having a solid portfolio. So, patience is no need to run and make any crazy decisions there. Chuck is always buying, even if it's just little. Perfect. Love it. Diane is holding right now. Dollar cost averaging for TT. Lorena is still buying. BG, keep buying, and I hope it stays down so I can buy a lot at a cheaper price. Buying. No selling, just bargain hunting there. Love it. Hans, buying it, market goes down, selling if the market goes up. So that's more a short-term focus there. Talk option trading, Johnny Reese. We could do some stuff on options and look at some of the stuff I'm doing. And if you want to see all of my plays, I put those in my Cash Flow University Discord group, where we have a lot of great folks that go over, a lot of great teachers and stuff that post all of their trades that you can follow along in our teacher and buyer buys and sells. So we try to focus. We're not doing YOLO trades and stuff to say, hey, you made $8,000 on this trade. It was pretty simple. We're doing stuff like selling cash secured puts, selling covered calls, doing option and credit spreads and stuff like that. Trying to do it in a more professional manner, trying to do it in more of a safer manner. I always put that in parentheses there, the safer, because options are highly risky, but we try to take a more safe approach to build up passive income and help folks utilize not only their current portfolio, but add some extra income to it as well. Diane, stocks are breaking their all-time high. I feel we are heading to an all-time low after this bull run. That would be quite the drop off there, Diane. And if we do get it, I hope the folks that, like Lex, have their money ready to go, they're going to be getting some great bargains there. But an all-time low to Hans is 0. Mariana is from Tucson, Arizona. Awesome. I was out in Arizona last week. And so awesome there. So some great content there. Good to have you back. Awesome. So let's get back into the slides here, and let's look at, I've talked a lot about this being a one-sided rally. I've talked about it being top heavy. We are starting to see some broadening, which has been a positive, and that's going to, when you look at a rally, you don't want to see it be top heavy. You don't want to see a rally be just one or two sectors. Through the first half we looked at last week, and we saw there was 3 main sectors. You had industrials, you had communication services, and then obviously you had technology that really carried the torch. All 3 of them were up over 30%, which and the rest of them didn't even hit double digits. So obviously it's only the first half, but it was really top heavy. So when we look here, you could see the S&P 500 year to date right now. So this is through today. We are up 17.7%. Again, that is amazing for a full year. That would be equivalent to 2 years on the average S&P 500 over the past 4 decades or so. Usually, around an 8 to 10% average annual return. So that would put us pretty close to that. But when you look at we've talked a lot about the S&P 500 equal weight ETF. So the S&P 500 is market cap weighted. So Apple's, Microsoft's, Google's, Meta, those are all very top. They have much more exposure to those stocks than they do the lower end stocks and the smaller. So it doesn't give you a full representation on how the entire economy is doing from public company standpoint. So the equal weight ETF does. And that is trailing by half the amount of the S&P 500. That tells you that it is very top heavy right now. So only 8.4%, I should say, not say only, but 8.4% year to date. Now let's look at more technology specific. And when we look at the XLK, which is the Technology Select Spider ETF, you could see right now year to date, it is up 42%, which is just amazing. And let me pull that one up for you guys so you guys can see the XLK. Here's the XLK. This is, a low cost ETF. You can see it's a 10% expense fee right there. We're trading at $176. Go here to holdings. You can see it's 100% technology, very little cash left, so it's fully invested there. But you can see Apple accounts for 23%, Microsoft accounts for 22%, NVIDIA accounts for 4.7%, Broadcom, Adobe, Salesforce, Cisco, and the list goes on. And the top 10 account for 69% of the entire fund, and they have 68 funds, or 68 stocks, I should say, in the entire fund as it is. So that one is up 42% year to date, 43% if we want to round up. So it's definitely interesting to look at from that perspective, to see that one-sided trade. So another interesting one to look at, though, is the ProShares S&P 500 X Technology ETF. So that is XPXT. That is up only 9.3%. So when I take out technology, we are only up by 9.3%. So that's the entire S&P 500. But when you do take out that entire sector, you could see that we're only up 9%, which is insane. So let me pull that up on the screen here for you guys to see. Add it to the screen. I was looking at this earlier. There's this big old drop-off line. It's a bug in Seeking Alpha right now, saying that the year-to-date we're only up 2%. Obviously, we did not crash today, and there's nothing after hours. So I had to do the old manual calculation here for SPXT. And here you could see the holdings breakdown. For some reason, they have 0.9% of technology. But the interesting piece is they still own Amazon, has a large weighting. Tesla, second largest weighting. Google, Meta, Berkshire, which has Apple in it, obviously 40% of Apple. And so all of those those are still the communication sector, which have a technology component to them. And they've been huge gainers in this market. So the fact that when I go back here and I see that the ProShares X Technology is still only up 9.3%, that just tells you how much the bottom half, or the bottom 400 really, of the S&P 500, and you have the likes of Meta and Tesla and Google and Amazon, which all have performed. Meta, of course, has just knocked it out of the park there. But what it doesn't have is the Apples, the Microsoft, and all those semiconductor, NVIDIA and AMD and stuff like that. So all those are pulled out, because NVIDIA has been one of the top performing ones. But that's just an interesting, piece to look at. I don't know what your guys' thoughts are when you look at equal weighted and stuff like that. But what is high, knowing this now, what are some stocks? Give me like two stocks, one or two, that are high on your watch list. Like, what are you looking to buy if the valuation, say, went down, 5, whatever your valuation you're looking for on a particular stock? What stocks are highest on your watch list right now? And not saying that, hey, I really want to buy NVIDIA. I wish it would come down 40%. Let's say if a stock only came down 5 or 10% right now, and that would put you into your valuation sweet spot. Which stocks are highest on your list right now? Let me know in the comment section there below. It'll be interesting to see if we're going to see any tech names there. So to answer this question here, the Discord group VG is Cashflow University. So I'll put that in the link down in the description as we conclude this. You can come check it out there. You can join for a month if you want, see how it feels, get a feel for the whole group. But it's a great group. We have over 300 members there, just sharing ideas, talking options. There's a real estate component as well. We have a teacher that goes over Turo rentals for folks that are looking to rent their car. So we're focusing on trying to find ways for folks to earn more passive income, and doing it in different ways. VG just started to invest again on my own, and I want to learn more about covered calls and other stuff that I hear about. So if you're ever interested in working with me one-on-one, I have a 6-week, I'll talk more about it here at the end of this session, but I have a 6-week investing accelerator course. I work with 7 individuals one-on-one throughout that 6-week period. No prior investing experience is needed. We have plug and play. It's completely customizable. They're 60-minute sessions. You can email me directly. We can set up an interview to see if it's a good fit for both of us, and try and get one of those slots coming up in the next month. So I have 2 more slots that are going to open up the 2nd week of August. So make sure you email me if you're interested in joining that. We go over covered calls and selling cash secured puts and finding ways to build more passive income. Michael said, Powell literally said there will be 2 more. And that is his words directly. So, what the Fed hasn't really led us astray. What they've said is what they've stuck to, even though folks keep thinking, for a while it was, no, we're going to have cuts at the end of the year. We're going to have cuts. And he said, no, cuts aren't anywhere close. Those aren't even in the discussion right now. So a lot of folks are trying to get ahead of the Fed, and it's just, not the case right now. Point of Tranquility thinks we're in a tech bubble 2.0. I know valuations have run, but at the same time, they've also fallen. If you look at 2022, so they're bouncing off of these lows. And when you compare the valuations to the tech bubble in the 90s, the dot-com bubble, they're drastically different. So they're high. I'm going to agree with you. The valuations of Apple's and Microsoft are high, but I don't think they're out of touch by any means. I do hope we do get, a little bit of pullback in some of those. But yeah, I'm not going to say that we're in a bubble or anything like that. So Lex top picks here, or top of his watch list, I should say, are NEE, NextEra Energy, AbbVie, and Google. AbbVie's the one that I sold some cash secured puts in, right around the $125 level is one I'm looking at, that and below. I've owned AbbVie, as you know. AbbVie is a top 10 position for me. Trimmed it, I believe, at the end of last year. So made some good profits on that, but it's still a sizable position for me. They're going through transitions with Humira, but they have some great blockbuster drugs that are up and coming, and I think that AbbVie has a very bright future moving forward, which is exciting from that standpoint. So AbbVie is definitely one high on my watch list. Google is a big name that I own outside of my dividend portfolio. And so that's a great one to have there as well. 2001 Cobra is going with Maine, so wants that monthly dividend. Point of Tranquility has RS, NUE, and CI, so some Cigna. You want some insurance exposure there. CG is looking for some Starbucks and some a dividend growth ETF, DGRW, which we've covered on this channel recently in one of our ETF videos. That's one that's high on my list as well. Kevin is looking at Microsoft. That one's going to have to, I already own Microsoft, but that one's going to have to come down a good chunk for me. But out of the top tech ones that I'm looking to buy, Microsoft would be the highest on my list. If we're talking about Google's, which I already just discussed that I already own a good portion of. Microsoft I do own, but I own less of that than I do of Google and Apple. So out of those three, I would go with Microsoft for myself. If you think that there are going to be numerous rate hikes, what does that do to your investment strategy? So that's really where I'm focused right now, is I believe there's going to be one, probably two more rate hikes, whether it's hike, pause, hike, or hike, and then we go on this elongated pause. I'm going to continue knowing that we're at the end of this cycle. And if the economy continues to show that it's on stable footing, and this soft landing appears likely, then nothing's really changing the way we're doing it. I'm always really looking at valuation. You always want to take the macro into account when you're investing in a particular stock. But if things continue, and I know these other underperforming industries are going to turn things around, then I'm going to focus more on those that could benefit with a economy that continues to putt forward and not fall into a recession. So there's some great values right now in the REIT sector. However, I'm overexposed at my 20% limit that I kind of cap myself at. So I'm trying to make some moves within my portfolio. And again, you can follow my entire dividend portfolio at the Dividend Investor's Edge by being a premium subscriber. And I do monthly portfolio updates. You can see all my buys and sells, and I've already made a good portion of those through the first half of July so far. So that'll be interesting to see how many of those I'm going to do for the rest of this month here. David is looking for some Altria Group, so some high yield there. The Dividend Investor CPA, I've been trimming Microsoft and Apple, adding to REITs and alternative asset managers. I would like to add MasterCard to complete ownership in the payment processor sector. So I'm assuming that you already own Visa, because that's a stock that I like a lot. Both of those, Visa and MasterCard, great dividend growth stocks. Low yields, you're not really investing them for the yields right now, but you're getting some pretty strong dividend growth. People continue to want to travel. We're seeing it with the airlines. And when you travel, you most likely travel with your credit card and you don't travel with cash. So the credit card companies are just continuing to rake it in. So, definitely having MasterCard on there, trimming Microsoft and Apple. You never want to say it's a great idea, but I totally get it. And I did it probably, I don't know if it was 3 or 4 months ago. So I've missed some of these continued rallies, but I just couldn't justify and having overexposure to one particular stock, just trying to stick to my strategy, even if I lose some money in the short term. So JC is going with Google, Microsoft, and Vici. So a couple technology companies, then mixing it up with my top REIT holding, Hershey's. So Trayvon Carter wants some Hershey's there. So the chocolate company has done great with dividends. Let's pull up Hershey right now. The Hershey company, I believe, is how you actually Hershey company. And let me show you the dividend stats here. So over the past year to date, they're up only 5%. And the chocolate company is over the past 12 months, 8.5%. So when we look at the dividends here, though, they're going to get an A+ rating from Seeking Alpha here. A decent yield, 1.7, nothing crazy there, but you're getting close to 10% growth, and they've been growing it for 13 consecutive years, which is awesome there. You have it's a low payout ratio. I like to look for 50 to 60%. Below that, I'm good with it moving forward. So I like that one pick, and I actually haven't looked at Hershey in a while. So thanks for the reminder. That is going to be one that I'm going to mark down here and potentially see a future video on. So what else we got? Chris is going with the TQQQ, some higher leverage there. Adam's got NOG and Vici, like that. ADC, total returns. I like that one. Diane, any insights on Bristol Myers? So I recently did a video on Bristol Myers being one of my cheap dividend stocks to take a look at. They just have a loaded pipeline. They're trading right around 7 times 2023 earnings. The healthcare sector as a whole has been, hit hard and just underperforming. Even the likes of Johnson & Johnson, Bristol Myers, we've seen AbbVie continue to come down. Merck, Pfizer is in the dumpster box as well. So definitely, if you're value hunting, healthcare is a great spot to look. If we dip into a recession, healthcare is a great spot to be in. It's more defensive. I have a good holding position already in Bristol Myers. They got a safe dividend, a continued growing dividend, and they're continuing to pay down debt. They have solid free cash flows. They took on that Celgene acquisition, which brought on a mountain of debt, but they continue to pay growing dividends. They continue to do well with their capital allocation. So Bristol Myers, if you're value hunting and you're patient, you have a long-term horizon, that's a great one. So great question there, Diane. The Dividend Investor, back to spreadsheets for me. Have a great day, everyone, and keep up the good work, Mark. Thank you for joining today, buddy. All right, Bluegrass has got a question. CVS and SU, both with a 10 rating on tip ranks and nearly a 30% upside, as well as a 5% and 3% dividend, respectively. A win-win. Yes, CVS and its counterpart Walgreens are both trading at some very low valuations. So Diane did buy Bristol Myers recently. Thoughts on why healthcare is down? It's just, I just touched on that a little bit, but some of these bigger ones, I mentioned Johnson & Johnson. There's different cases for all of them, but Johnson & Johnson, we're really waiting for that pending litigation that's going on. We saw a lawsuit there in California recently. So once that gets set aside and hopefully they come to an agreement here soon, I think Johnson & Johnson can really make that leap forward. They're going to report earnings here coming up for Q2, and I think we're going to see some good growth out of medical devices and pharmaceuticals, which there was a report out on CNBC today about I think Johnson & Johnson got an upgrade, if I'm not mistaken. So that was some positive news there, but it's really been risk on through 2023. We're looking for big growth again. That's why technology has been leading. That's why communication services has been leading. So the defensive groups, the energies, utilities, healthcare, those are about as defensive as you get. Those were the 3 worst performing through the first half, as we looked at last week. So it's just really been, a lot of investors, institutional and retail, just playing the market cycles there. And that's why, one reason that healthcare has really struggled to date. Mom has 2,000 shares at $30. I believe you're talking about Bristol Myers. So let's see where that Let's see where Bristol Myers is at today. 62. So she has doubled the, wow, exactly 0 today for Bristol Myers. SPGI on the expensive side, but great dividend growth. What do you think from the J? What do you think of bond ETFs? It's not something that I, get all excited about investing in at all. So, don't really have a take on bond ETFs. If I'm going to be looking for fixed income, which I don't, I have my high yield savings that I've talked about right around 5.25% percentage. For some of the money I handle for family members, that are closer to retirement. We've done some UST bills buying there, some corporate bonds and stuff like that, but never really got involved with any of the, just rather buy the stuff that, I know and want rather than mixing around with any of the bond ETFs. So don't really have a good read or a good answer, except for it's not something that I kind of focus on. Chris, though, is holding some bond ETFs. He is holding TMF until they start cutting. So there you go. Chris is going to be your guy to talk to more about that. So let's look back here. And again, so it's interesting take to look at that and see how we are on this one-sided craze. So again, I always like to mention, if you're looking for more information, definitely sign up for the Dividend Investors Edge. You can see the URL at the bottom of the screen there, thedividendinvestorsedge.com. You can sign up for my free newsletter, which goes over, the top 5 news articles and mentions and data points that we're looking at in the stock market. You can see how the indexes are doing for the week and year to date. We look at investor upgrades and downgrades for notable dividend stocks and a whole slew of other things. And you can also consider subscribing to the premium subscription, where you're going to get monthly portfolio updates, like I mentioned throughout the Dividend Power Hour today. You're going to get 2 individual stock deep dives. So this is where I spend a lot of my time, hours, just in looking at stocks, diving deeper into them, getting into the financials, going through the cash flow statements, determining the safety, determining the fair value of a stock. And we put out 2 of those each and every month, covering those. And then we have our investor valuation dashboard that is still coming. I'm hoping that this weekend is when we're going to have that officially launched, with our first 5 to 10 stocks on there, and just continue to grow that and update that on a monthly basis. You can join the premium one for less than $1 a day. And for those that are looking to, become your own money manager, consider signing up for my 6-week investing accelerator course. You don't have to have any prior experience. It's one-on-one instruction with me, 60-minute sessions. We start at a high level, start with the basics, and we build on that, building a strategy and how we can act on that strategy. And then we start showing you all the different metrics that I use to know how to value a particular stock. We look at ETFs, index funds, mutual funds, see how those are the same, and look at the drastic differences between the 3. Retirement accounts, to see which one is best for you based on your situation, your risk, your profile, time horizon. Start diving into the 3 main financial statements: the balance sheet, income statement, cash flow statement, and you really utilize and see how you can use those to determine the health of a company and the health of a dividend. And then for those of you that are looking for an introduction to stock options, that is another topic that we can discuss as well. Again, when it comes to options, I'm usually an investor by utilizing cash secured puts. This is how I get into positions. So like I mentioned at the top of the hour, I'm looking to get more into AbbVie. I already own a good portion of AbbVie. AbbVie right now trading in above 130, I want to say. So if I look over here at AbbVie right now, we're at 133 and change. I'm looking right around that 125 or lower. So what I do is I sell a cash secured put at the 125 level. I collect premium. If the stock stays above that 125 level, I keep that premium. That's mine to take. And we do it again. However, if we get below 125, I will be on the hook to buy 100 shares at that 125 strike. So if it dropped to 120, obviously I'd be $5 in the hole. But that's a valuation I'm comfortable with, and that allows me to not buy it at 133 and instead buy it at 125. So that it's just part of the due diligence that you do. We go through all of that if that's things that you're looking for. So we're almost at a full hour here. Do you guys have any remaining questions for me before we close out this Dividend Power Hour. It's always great to interact with you guys, to see all the questions that you put in there, and just not be able to, even though I'm still talking to a camera, I still feel like there's an audience there. So, we have over 100 folks that join in this thing each and every week, and we have the last one had nearly 5,000 people that have already watched the replay. So it's always good just to interact with viewers and subscribers to my channel. I greatly appreciate it. And as Jim always says for me in the comment section, he's not there yet, but smash that like button down below. So I appreciate it. So what other questions do you guys have? Thoughts on Nike? So Nike, let's take a look at Nike. So let me pop up the screen here. Look at Nike. That is one we're thinking about doing for one of our July deep dives. So if you are a premium subscriber, you could see more about Nike there. So over the past 12 months, stock's pretty much flat year to date. It's been under more pressure, down nearly 10%. I know that they've been dealing with a lot of the China growth. Stocks like Nike, stocks like Starbucks, I should say, they have a big dependence on the Asia Pacific, China in particular, those markets, and that China just hasn't gotten things going like a lot of economists and investors had expected. And for that, Starbucks is looking to open a store. I think it's every 9 hours in China. Like, that's their second largest market. So that stock has come down from 115, 120 level down to, it was below 100. And I think it finally surpassed and got back above that. But Nike's kind of the same story. They're still dealing with some cost inventory stuff that they're trying to get through here. So, and it's one of those consumer discretionary plays. If student loans are coming back, it's where we're going to have to pay those. We're going to have less of that extra money to go out and spend on a new pair of Air Jordans or whatever it is. So it's an interesting play. It's not a huge, dividend stock play. They have 126, $1.26 in terms of yield, but it is strong in terms of dividend growth. It has been a lot stronger in years past. That's come down. It used to be right around, 15, 17%, but now we're at 11%. They've increased it for 10 consecutive years. So I would like to see more from the China market, see that get going again before I take a second look right now at the likes of Nike. But as I go through my deep dive, look at fair values, do some discounted cash flows, and determine a margin of safety, we'll see where that kind of comes out. Would this be a good time to buy RTX? So that's a position. Raytheon is a great one. And that, I like those defense contractors with a lot of the unrest we've seen over in with the Russia-Ukraine. We see China and Taiwan starting to perk up a little bit. Talks with NATO, and a lot of countries a lot of countries are really looking to bolster their military. So the likes of Raytheon, the likes of Lockheed Martin, and those and General Dynamics, even Boeing, are really they have these backlogs that go out years. So those are interesting ones to definitely look at. I own RTX, I own Lockheed Martin for those two, and looking at doing some option plays with Boeing. So, but on the flip side, none of these stocks look that cheap. I think they're really close to fair value right now where they're trading. So they're not like a deal like we were talking about with Bristol Myers. Obviously, that's a healthcare company, has nothing to do with Raytheon. But in terms of a stock being cheap, Bristol Myers at single digits compared to Raytheon, those are two different. So I think I would call it fairly valued, just based on my opinion alone. Some more comments on Nike, down almost 15% in the past 3 months. Chris is holding Nike long term. The J is adding Nike on all dips. CG wants to add it under 100, so he's about 7% or so from that. Do you teach covered calls? I do teach covered calls. Diane, thanks for joining us. First-time member, great to have you. Anybody fooing into cryptos yet? So funny story is I had, and in our Castro University, we had a teacher that posted a Coinbase trade yesterday. A bunch of us jumped in, including myself. I don't follow Coinbase all that close, but he kind of laid it all out there. And I said, hey, let's take a flyer on Coinbase. Coinbase was up, I think it was 25% today if I look. Let's look at what Coinbase ended up. It was up 25 at one. We have 24.5%. So we made some good money on that one in less than 24 hours there. So that's the extent of my crypto right now. Where did I leave off there? Crypto FOMO. Energy, for me, energy has really been focused on XLE. So that's my exposure. It's not a huge position. It's not a small position. It's right in the middle. I would say it's probably 15th ranked. And I own about 40, what I own, 42, 45 positions in total, which includes ETFs, index funds, and individual stocks. That's in my dividend portfolio. So I have a whole slew of growth stocks, non-dividend paying stocks as well. Not as many as I own dividend stocks and ETFs, but energy XLE is kind of how I play that. It gives me exposure to all the big players there. So that's kind of my, and I did add some XLE this week. What are your thoughts on the AT&T earnings call? Its valuation is pretty low. So AT&T is one I added to, what was it, last month? It's just been, I've added to it twice now. So I think it was in April, or no, it was in May and June was the two times that I've added to it. I'm not expecting a ton of growth out of AT&T. It's really just a yield play for me, getting close to 7.5%. In terms of dividend yield, the dividend yield's not going to grow all that fast. But in terms of valuation, I feel like, I can get some growth out of this stock and get a high yield at the same time. But I'm trying to be careful and not try to catch a falling knife. They've had a lot of missteps over the years with a lot of bad acquisitions. But the CEO is kind of, taking those off the balance sheet, in a way, rid themselves of that, starting to pay down that mountain of debt. Earlier we talked about Bristol Myers having a mountain of debt. AT&T has a actual mountain of debt that it continues to try and pay down. They've already had to cut their dividend by 50%. So, you're still getting a 7% dividend yield here. So it's really more of an income play for me at a low valuation. So if you're looking for big growth, AT&T is probably not the stock for you. Would you invest in Cube? Any thoughts? CubeSmart is a great REIT. Another position I own and looking to build on that position. They have a great technology, a great portfolio, and where their properties are in high quality neighborhoods, high income neighborhoods. So and the fact is, self storage is always a great place to be. Especially here in America, folks just can't get rid of their stuff. So, if you're in housing and we hit a recession, we're going to see folks potentially downsize, but they won't get rid of their stuff. They'd rather throw it into a self-storage unit. Even if you're in your regular home, you buy more stuff, you need a self-storage unit. So, self-storage is always going to be in my portfolio, whether it's public storage or whether it's CubeSmart. I actually own now more CubeSmart than I do public storage. So that is a REIT that I like a lot. So I'll take a few more questions here and then we will wrap this up since we are at our hour. JC inherited AT&T. Too much for my liking, but it pays a good dividend. I like that. It's a good question, Chris. I'll have to get back to you on that one, and you could email me and we can kind of chat. But a good REIT that tracks basic family homes. So I know there's ones that have like small home rental type stuff, but I'd like to get some more context on that question, what you're looking for there. So that kind of wraps up our dividend investors, the dividend power hour. And if you, again, sign up for that free version, at least, of the Dividend Investors Edge. You can get all great content there. You can take it up a level premium subscription if you want, less than $1 a day. If you want to work with me one-on-one, sign up for my 6-week Investing Accelerator course. You just have to email me, mark@russinfinancial.com. I will put that down in the description below as well. Again, guys, thanks for joining me yet again. Thanks for all the support on YouTube. I appreciate it, and we'll see you next week. Have a great day.